Okay, welcome to our last section in chapter 22, which is doing our closing entries and also our reversing entries, wrapping up our entire fiscal period and getting ready for the next one. So after our financial statements are done and our adjusted trial balance is done, we're ready to journalize and close our entries for our corporation. So remember that closing entries are recorded on a new page of the general journal. They don't have document numbers either. Closing entries is just used as the heading. So our first thing that we need to close is our income statement accounts with credit balances. So if they have credit balances, in order to close them, that means we have to debit them to zero them out and prepare them for our next fiscal period. Here are all of our income statement accounts with credit balances. I listed them there for you. And then the credit in this actually goes to income summary. So we've closed before. Again, this is a little bit of a review happening back in chapter 16 again, looking at closing out some of these uh, accounts to get ready for our next fiscal period. So here's our general journal. We have our closing entries. We list all of our income statement accounts with credit balances. Remember, they get debited then to zero them out, and the total of those goes to income summary. Then we have all of our income statement accounts that have debit balances, which means that they are going to be credited to close them out. These are listed here. It seems like not very much, but remember this says all expense accounts. That's where it gets really long for this one. So since all of these are going to be credited, their total is going to be debited to income summary. The one that you need to be aware of here is that cash short and over can actually have either a debit or a credit balance. So just make sure you're aware of that because that can go on either one of these. So this is what the closing entry looks like. All of these accounts that have debit balances, they get closed with a credit, as you can see here, and then their total up here gets debited to income summary. Now, we have our closing entry for net income. After our closing entries for the income statement accounts are posted, income summary has a balance. It can either be a debit balance or it can be a credit balance. If income summary has a credit balance, it means that we have a net income. If income summary has a debit balance, it means that we have a net loss. So when net income happens, we're actually increasing our corporation's retained earnings. Obviously, a net loss would decrease retained earnings. And then after this closing entry happens, income summary is actually at a zero balance. So when we look at this number is actually the difference in income summary, whether it has a debit or a credit balance, that goes here. And then retained earnings gets credited. Now, if this were a net loss situation, these two numbers would be flip-flopped. Right? Retained earnings would be debited and income summary would be credited. Our last closing entry is for dividends. Dividends obviously reduce retained earnings because they are where we actually pay the money out to our stockholders. So closing entry actually debits retained earnings and it credits dividends. Dividends then will have a zero balance and will be ready to go into the next fiscal period. Okay, now we just learned about these in chapter 21, our reversing entries. So remember that if we did an adjusting entry that's going to create a balance in an asset or a liability account, that adjusting entry needs to be reversed. So when we look at Sun Treasure's adjusting entries, there are 3 of them that created a balance in an asset or a liability account. The first one is we had accrued interest income that made a balance in interest receivable. We need to reverse that. Then we have an adjusting entry that made an accrued interest expense in interest payable. We need to reverse that. And the third one is an adjusting entry for federal income tax payable. That one needs to be reversed as well. So what we see here is these are our adjusting entries. Interest receivable, remember a reversing entry essentially just flip-flops it. Same thing with that interest expense one and our federal income tax payable. Notice again that reversing entries always happen on the first day of the next fiscal period. So this is January 1st happening here. And then all that this is saying is this is our accounting cycle for a merchandising business. We have now made our way through the entire thing. Can you believe it? It's been a long road. It actually started in accounting 1 and ends up here. This one actually has 13 steps all the way down here. So we have done all of this as we have gone through an accounting cycle for a merchandising business. So that's going to bring us over to 22-4. We're going to do our closing entries and reversing entries, and we'll be all ready for a new fiscal period.